Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Good morning. Welcome to the U.S. Markets Wrap. And looking at the screen right now, it is a bit mixed and largely lackluster as we see the S&P 500 posting a modest gain, up 0.2% to 5,918. We've got the Nasdaq Composite underwater by 0.1%, and the Dow outperforming, but just 0.3% higher, around 100 points to 42,635. So traders assessing the latest FOMC minutes on where rate cuts are going for the rest of the year. And let's look at the minutes released from the December meeting 3 weeks ago, reflect that nearly all committee participants found that upside risks to the inflation outlook has increased. So that adds to concerns that there may be fewer rate cuts expected this year. So let's check in now with Christine Short. She is the Vice President for Research at Wall Street Horizon. Christine, thanks for joining us on the show again.
Yes, Happy New Year. Thanks so much for having me.
Happy New Year to you, Christine. Let's talk about where the year is going when it comes to rate cuts, starting with your takeaways from the FOMC minutes.
Yeah, I don't think the minutes were terribly surprising. There's been some whispers of some more cautionary language coming out of the Fed, like you said, concerns over inflation and the impact of some of the new policies that might come into play when President-elect Trump comes in the office on January 20th, officially being inaugurated. And there's been talk some time about how those proposed tariffs on goods from China, Mexico, and Canada would potentially, impact the cost of goods here in the U.S., especially after the strides we've made on lowering inflation in the last couple of years. And so because of that, the minutes indicated the pace of policy easing would likely slow this year. I follow the CME Group's FedWatch tool. We had been seeing that for the weeks leading into the end of the year, that the pace of cuts, which, just before their September meeting when they implemented their first rate cut in over 4 years, the expectation was for 6 cuts in 2025 from the January to the September meeting. And as you saw in the meeting notes today, it looks like they're only pricing in about 2 cuts, so 50 basis points of cuts versus, a few months ago, I would have told you that the expectation was for 3.25 basis. So many more, maybe 6 or more basis or 6 or more cuts for this year. But now that's been whittled down to 2 as of these minutes.
Yeah, the next FOMC meeting is 3 weeks away, and it looks like markets don't see any chances of a 4th straight rate cut. So let's talk about what is playing out in terms of the data we're getting. So if you look at the U.S. economy, it does look like it's been quite resilient.
Yeah, and I think that's part of, they said today that the inflation concerns were around some of the potential new policies we might get, but even prior to that, like you're saying, the U.S. economy has been quite strong. Inflation has been sticky for that reason. Most of the economic data, even expectations for GDP, are still relatively high. 3% or 3.1% is what the Atlanta Fed now estimate is for. If you look at some of the jobs data, labor market, still pretty resilient here. We are waiting for Friday's job report. Non-farm payrolls are expected to show the U.S. added 153,000 jobs in December. Unemployment changed at 4.2% is the expectation. And yeah, that will show a little bit of a downturn from November's NFP tally, but it just shows the U.S. labor market still growing at a healthy pace. We had ADP private payrolls out today, a little bit lighter. So private sector companies added 122,000 jobs for the month. That was down from expectations. But I heard you earlier talking about how are you being paid? And that stat did show that wage growth grew at a pace of 4.6% from the year ago. And that actually was the slowest pace of growth since July of 2021. So that's private payrolls. So we know wage growth has been weakening as of late, but overall the jobs numbers, the number of those applying for unemployment assistance has been falling. So labor market's still quite strong here, and that makes it a little harder for the Fed to go for those 6 rate cuts this year.
Yeah, Christine, one part is how well you are being paid. The other part is how well you are spending when it comes to, I suppose, the consumer sentiment. How much is this going to play out in the next earnings season?
Yeah, we'll hear from consumer-based companies and retailers. Certainly the holiday season was a strong one here in the U.S. It showed that Folks are still out there spending, which usually correlates with how they feel about their job and the security of their job. Speaking of jobs data, we just saw yesterday the job openings and labor turnover survey, which was released for November, so it's on a 1-month lag, showed job openings climbed back up over 8 million. So that's a 6-month high. So there's still quite demand out there for jobs. So that certainly should make Americans feel good about their position at their job and good about their ability to get another job were they to leave theirs. And that feeds into consumer spending, as we know. So January, usually there's a bit of a slowdown after the holidays, but consumer sentiment remains steady.
Yeah, and this Friday we will hear from the likes of Delta Airlines and the banks soon enough. So if you look at, I suppose, the next earnings season, there's likely to be a lot of talk about how tariffs are going to be affecting, I suppose, the next few quarters.
Yeah, we started to hear some of that conversation on the Q3 earnings calls back in October and November. Some of those releases came out before the results of the U.S. presidential election were known, so there were, still uncertainty there. We started to hear plans being formed, some corporations saying they were going to pass costs from tariffs down to the consumer, so expect the cost of goods to go up. There were others that were, Steve Madden comes to mind, the shoemaker, that talked about looking to move supply chain. So we'll hear more solidified conversations about what might be next for some of these companies that will be impacted by tariffs. But overall, right now, the estimate for the Q4 earnings season is for S&P 500 earnings per share growth to hit 12%. That's the highest in 3 years. Revenue growth expected about 5%. So some of the same winning sectors that we saw for most of 2024 will continue to lead into this final sector. So that's tech, this final quarter of the year. That's tech, communication services. We'll see financials doing a little bit better. We'll still see some of the same lagging sectors like energy, industrials, and materials. But that starts to change when you look at the outlook for 2025. Some of the growth moves away from tech and into some of those lagging sectors that weren't performing so much last year.
Yeah, you mentioned 12%. That's the expectations for earnings in this Q4. It kind of paints a picture that we are set for a pretty banner year again after 2 pretty good years, 53% in 2 years for the S&P 500. So it looks like another solid year for the S&P 500.
Yeah, I mean, look, the big banks are saying expect the S&P to grow about 10%, in 2025. Yes, that's down from the last 2 years. We've had over 20% growth, but certainly nothing to sneeze at, right? 10%, we'll take it. It's a little bit modified from the last couple of years, but it's still a great number and again, supported by some really strong underlying earnings growth and strong fundamentals from the companies in the S&P 500.
All right, let's dive a bit deeper into tech. And we had the CES show playing out in Las Vegas where we had Jensen Huang, CEO of NVIDIA, talking up AI, talking about how AI agents are going to be the future for businesses. So looking at where things are going for the Magnificent Seven, are we expecting also the same type of, rally we've been seeing the past 2 years?
The expectation from analysts are that the Magnificent Seven will still really be the drivers of growth in tech in general, and certainly the AI play is there. But the massive concentration we've seen in just those handful of stocks over the last 2 years is expected to broaden out a little. So that was always a concern. How can you continue to support a market based on just very high growth from a handful of companies? What happens if that goes away? Obviously, it turned out pretty well in 2023 and 2024. But now analysts are expecting better performance from companies outside of the tech sector. So names, beaten down sectors such as industrials, materials, those are anticipated to make a comeback. I think the Magnificent Seven currently are expecting 2025 earnings growth of about 21%. And then the other companies, so the other 493 companies outside of those seven names, are expecting earnings growth of about 13%, whereas in the past year they only produced about 4% of earnings growth. So that's certainly an improvement. Yes, tech is likely going to lead the way. That's what analysts are currently expecting. But, anticipate come up from those other names that were downtrodden over the last year or two.
All right, bit of catching up to do for the other 493. We've been in conversation with Christine Short. She is the Vice President of Research for Wall Street Horizon. Christine, thanks for your time and insights. Always a pleasure chatting with you.
Yeah, it's a pleasure. Thanks for having me.
All right, have a great year ahead. Stay Money FM 89.3.
Before acting on the information on Money FM, Please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.